Hello everyone, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This particular video is part 18 of a series I've been doing on the various sectors as reported by FactSet. And I've got one more to do after this, and then I'll be moving on to starting to look a little closer using FastGraphs to analyze individual stocks. So what I might suggest to you, if you get anything out of these videos at all, I think you'll like my future videos even better. Go ahead and hit the subscribe button below, because I believe you'll be really glad you did when I start getting into individual videos and showing you some more comprehensive, analyze out loud information on individual stocks. In this particular video, I'm covering the transportation sector, and it's primarily I'm covering airlines and air freight couriers. I'm going to be covering Delta Airlines, Southwest Airlines, and I'll be covering UPS and FedEx and the couriers. And there's a couple things I want to point out as I go through these videos. This is not a sector that I'm real fond of. I find it very, very difficult for these companies to make money. I've really never owned airline stocks, and for that matter, a lot of other transportation companies I've tended to avoid in my career. And let's look at what's going on here. Let's look at Delta. Let's start with Delta. There's a couple of points I want to make about this particular company. Number one, the company did reorganize and came back, public in April of 2007. Of course, that was horrible timing just before the Great Recession. They did lose money, as you can see here, for the next couple of years. But then they recovered real nicely in 2010. And I'm going to shorten this graph a little bit so that we just look at the more recent years from 2012. If you go back to 2009, 10, 11, 12, and forward, you'll see that jet fuel prices have fallen precipitously. And as a result, that's one of the big things that impact any of these air carriers, whether it's carrying people like Delta and Southwest or carrying freight like UPS and FedEx. But the point I want to make is we've had this really great period of earnings growth here. In the case of Delta, I do want you to notice that the market tends to value this at a very low PE ratio. The normal PE ratio for Delta Airlines has been somewhere around 9 or 10. And so when I'm looking at forecasting and looking at future performance, I'm going to use that normal multiple. And what I'm going to do is I'm going to apply a 10 multiple to that so that we have a look at a valuation that makes economic sense. So you can see I've got a 10 PE ratio right here. And the bottom line is, even at a 10 PE ratio, the opportunity to make some really extraordinary rates of return for the next couple of years is very, very good with this company if you're looking at the earnings continuing to grow and energy prices continuing to stay low and jet fuel prices giving them some headwinds. So that would be very helpful. But let's go ahead and take a look now. Let's go ahead and look at Southwest Airlines in addition to Delta, because I've got a little more history here, because this is what I want you to understand about why I don't like the airlines. Once again, we see since 2009 here, if we go back in time and look at 2009 forward, we've had this tremendous surge in earnings. We've had some really nice earnings growth. If I look at performance, I want you to notice that Southwest Airlines has dramatically outperformed the market on a total return basis. They've pretty much generated about the same amount of dividend income as the market. But what's happened here is they've had this enormous earnings growth. The market values that at around the 15 to 18 PE ratio. Forecasting going forward, if I'm again looking at more normal PE ratios, if I went and looked at a 17 PE, which I showed on the historical graph, there's some extraordinary money to be made. If I was a little more reasonable at something around a 14 or 15 PE, I would still have these significant double-digit returns. But that's assuming this earnings growth occurs as is currently being forecast. But let's look at the long-term record of Southwest. I want you to notice that earnings were 79 cents in calendar year 2000. By 2012, 12 years later, they were 56 cents. And if you look at the performance of Southwest over this period of time here, which has been a very poor period of time in their growth posture, they would have averaged less than 1% a year. You'd have actually lost 13% of your money. Your 10,000 would have shrunk to 8,600. You would have received some dividends, but you would have still lost 11% of your money, or an annualized loss of 1% a year approximately. In contrast, again, when you take that from the time when prices for jet fuel got low, you had this enormous rate of return period of time where you had the growth. But that's what I find difficult about these companies. They're very, very sensitive to economic conditions and things like fuel prices being one of the biggest cost itemized. But that's also true, as I mentioned in the article. You also have to worry about labor costs, etc. So be very cautious, even though the numbers look great going forward, be very cautious with these companies. Let's move on now and take a quick look at the air couriers, the air freight couriers. We've got FedEx here, which everybody knows FedEx. This is much more of a growth story, about a 1.4% dividend yield, reasonable amount of debt. It's BBB rated. I want you to notice they've got a good dividend record. If I look at their long-term performance here, their dividend has grown by about, almost 17% a year, average of 17.4. Compound average growth is 16. They've outperformed the market rather substantially during this period of time, and this goes back to 1999, so this is long-term performance. If I shorten that time frame since just coming out of the Great Recession and look at performance, notwithstanding the fact that FedEx is very undervalued right now, if I look at performance here, it's a little bit of a closer call. It's slightly underperformed the market, because keep in mind, this is a very excellent time for the market. But as I talked about in previous videos, the market right now is trading at a premium valuation. FedEx is only trading at a blended PE of 12.3. I do want you to notice we're starting to see a nice recovery here as it's reverting back to the mean. So from a forecasting point of view, if we're looking at just a 15 PE on this stock, which I think this company is easily worth that, we see these 20% annualized rates of return or better going forward over the next several years. We have a modest dividend income because it has a very low payout ratio, but the company has been growing at almost 14% a year. So if this moves back to intrinsic value, so if I measured this to what I think FedEx is worth, that rate of return would be 16%. In contrast to 14%, which would, put it on a par with the S&P 500. Now let's go ahead and let's take a look at UPS. And there's some very interesting aspects about UPS when you're looking at it from the point of view of valuation and how the market has valued the company. Number one is I want you to notice this is much more of a dividend play. We have a current yield of 3.6%. The company pays out a significant portion of their earnings in dividends. If you look at their payout ratio, historically, it's averaged about 50% a year since 2012, or more, 55% in 2017. So you can see they're paying out a substantial portion. In contrast to some of the others that we've seen, the market has liked to apply a high valuation to this stock, but it is currently fallen into fair value. It's trading at below a 15 PE. If I look at forecasting and use the 15 PE as my benchmark, I've got a significant amount of capital appreciation and a 3.6% dividend yield, to boot, while I'm waiting for the company to appreciate going forward. And that's just the company staying at a 15 PE ratio going forward. Now, I'd also want to look at this stock because of the high dividend yield. I want to very quickly take a look at it from a standpoint of operating cash flow, because we get a slightly different perspective here. The cash flows have been a little more erratic. Again, that's a hallmark of these kinds of businesses, but the cash flows do cover the dividends, and it looks a lot, more undervalued based on cash flows than it does earnings. And then last but not least, let's take a quick look looking at EBITDA, or earnings before interest, taxes, depreciation, and amortization. And once again, you see very attractive valuation, but because this is more of a cash flow metric, I do want you to notice the inconsistencies in the cash flows here. Anyway, this has been Chuck Carnevale covering the transportation sector. I think there's a little bit for everybody here. UPS is a pretty good income stock. FedEx, I think, is a pretty good growth stock. And both Delta and Southwest Airlines are two of the best run airlines, passenger airline companies. And if jet fuel prices stay low, all these stocks could be good investments going forward. They don't suit me, but perhaps they do you. Thanks for watching. I look forward to talking to you again real soon. Thanks.